Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. In these recordings, we talk about the news that affects the market and then put it in perspective using our Elliott Wave charts. Today, the PPI report came out and it again was hotter than expected, but it had come down a little bit. We'll talk about that. In addition, we'll be featuring the symbols that you see on your screen now. And remember, if there's a particular symbol you're interested in, you can go straight to it using the chapters feature on the video. With that said, let's take a look at the charts. At the time of this recording, it is late on Friday evening, so the futures market is closed. Hey, if you like these videos, please hit that like button, or better yet, hit subscribe. You'll be notified immediately when one of these videos is posted. Thanks, we really appreciate it. Taking a look at the market today, you can see we did finish to the downside with that wave 4 moving up 86%. That means that this Elliott wave pattern is disqualified. So we take that off. What I've put on the screen is a 2 standard deviation channel, commonly looked at a metric for trending patterns. And as you can see on this move to the upside, we are staying within 2 standard deviations, but we're at the lower end of that double standard deviation chart. So if I would take that off, then we can take a look at this zigzag that we've been talking about where we got awfully close to that 411 number. And a lot of people would say, come on, you got awfully close to that, that counts. Yeah, I can see that argument, but I say that often within Elliott wave, we actually touched the line. We didn't quite touch it. We got awfully close, but we didn't quite touch it. And then you look at the volume and see we had rising volume today. Well, the news of the day, as I said in the intro, was the fact that we had a hotter than expected PPI report, up 0.3%. But then when you look at the chart, you can say, okay, we've come down from significantly where we were. Remember, the PPI is producer prices. That's the wholesale level. We'll get the CPI report on Tuesday. A lot of people are feeling like that carries more weight, and the market will really be waiting to see what happens with that CPI report on Tuesday. When you look at the PPI report, well, we had autos were down, energy was down, so some thought it would be a little bit lower than it was, but food prices were significantly higher, and so that's what caused the number to be just a little bit hotter than expected. So here we sit right at that 61.8% level. If we put the moving averages on, you can see that we are trading right between the 10 and the 50-day moving average, exactly where we've been for the last 4 trading days. So it does seem like the market is waiting on something to give us a breakout one direction or the other. When we look at interest rates, you can see that interest rates did bounce to the upside today slightly. The wave 4 right around 56%, so in between that 50 and 61.8% wave 4 corrective level. We could continue to move higher from here. We'll see. You look at the dollar, and the dollar pretty much took the day off. Not much going on there with a wave 4 right around the 43% level. If we look at the VIX, you can see that with the VIX also not a whole lot going on, considering the fact that the market did actually finish to the downside and finished on the low of the day, but just a slight gain in the VIX, but nothing significant. In Tuesday night's TradeFinder, we were talking about how the weekly chart has a lot of interesting things going on within it. I'll get to that in a second. By the way, if you haven't attended one of our TradeFinders yet, you can sign up under this video or go to our website at ewotrader.com. It's free. We do it every Tuesday night. We talk about the markets. We look for trade ideas, and we have a live. It's a lot of fun. Sign up and join us. Love to have you at the next TradeFinder this coming week. Well, when we look at the weekly chart of the S&P, since the daily chart is just kind of waiting to see what's going to happen, you can see that the wave 4 bounced off that roughly 61.8% fib level. Can we move down from here? We could, but are we going to make new lows? The weekly chart is suggesting no, that the lows are likely in. We'll see. I've been talking numerous times about how I think that the next quarter earnings reports are going to be pretty rough. We'll see how that plays out. I think it's going to be challenging for the market moving forward into that earnings season. So taking a look at some of our other U.S. markets on the diamonds, pulling back a little bit. So we're only at a 27% wave 4 correction. If you read the works of Elliott himself, he didn't really count that as much of a correction. So could we go lower? We could come down to that 38.2% level on the daily chart. But notice that we are in a labeled wave 5 pattern to the upside, currently in the wave 4, following a really nice move out of the wave 3. Looking at the Qs, here's what makes the market so confusing. We talked about this in TradeFinder as well. You literally have a tale of 3 different markets. In the diamonds, we're in a 5-wave pattern to the upside. Just completed a wave 3 higher. The S&P is like, we don't really know what's going on. We're just mirrored between the 10 and 15 average. But on the Qs, we're still in a qualified 5-wave pattern to the downside. One of our subscribers last night in our insiders meeting, which we do every Thursday night for our list subscribers, said, boy, what a challenging market this is. That's an understatement. It really is pretty challenging right now. I don't think the market knows where it wants to go from here. You take a look at this chart of the Qs, and you can see how important this 280 level is. Are we going to break that level? If we are, perhaps we are looking at a potential wave 5 lower. But if 280 can hold, can this come up and disqualify this 5-wave pattern as the diamonds have done and as the SPY have done? The Qs still haven't. Been talking about this for as long as you've probably been listening, that the Qs are going to underperform, and so far they have. Still in a qualified 5-wave pattern to the downside. Some stocks of interest. Tesla. Taking a look at that, you can see that we had a little bit of a wave 4 bounce, but just to that 23.6% fib level. We had a move to the upside today, but just back to 180. I don't think 180 matters. There's a little bit of support resistance here, but I really think the important level he tried to say on Tesla is up here at 200. I think that's going to be the key level. Can Tesla get above 200? If so, then you can look to go back long. But it's all over the financial networks, the concern with the amount of time that Elon is spending on Twitter, etc. And is that affecting Tesla's stock? Along with the fact that there's so much more competition in the EV world now. But sitting here right at 180, if we put the moving averages on, you can see that we're still close below the 10-day moving average. So again, I submit that to be bullish again on Tesla, you got to get above 200. Other than that, there's a chance we complete this wave 5 to the downside, and you could see Tesla at 150 or below. Where do you think Tesla goes from here? Do you think that it's mattering with all this Twitter stuff? Is Elon spread too thin? Is he taking some of his talent from Tesla over to help him with Twitter? You see all these things all the time. Leave a comment under this video. Post it under and tell me what you think about whether or not what's going on with Twitter has anything to do with what's happening at Tesla. But just this bounce back to 180, we were a little bit oversold from the 10-day moving average, just closing right there. So we kind of had an up day, but I don't think it really matters much. I've given you the levels that I think are important. Akamai was a stock of interest today all over Twitter, people talking about it, and you can see where we had this wave 5 that extended past the 100% level. So when you have that, when you have a wave 5 that extends past 100%, you look to see a 61.8% corrective move. And that's what happened. So Akamai hit this wave 5. It extended more than 100%. You don't look for a correction back to the wave 4 in that scenario. You look for a 61.8% retracement. It's done that, and it's just kind of going sideways here. So what we look for within Akamai is, where's the next directional move going to be? You can also see, here's another one of those zigzag patterns we've talked about, right at a 61.8% B wave correction. That means 100% extension on the C wave, and that's exactly where it went. And then it's come back down and tests the previous fib level. I mean, Akamai is just a poster child right now for Elliott wave. If you're newer to Elliott wave and you're watching this, I mean, how can you discount what's going on with these patterns and these fib levels? It's pretty amazing. Twitter, moving back to the upside. Another stock that's had greater than a 100% wave 5 extension, so you're looking for a potential move back to 61.8. I think we have to, on Nvidia, get past this level here at 180 first. You can see there's some congestion there. You could draw this line anywhere between 180 and 190 through there. It's trying. It's turning back to the upside. We look at the moving averages, and you can see we're trading above the 10-day moving average, actually even a little bit overbought in Nvidia. So I do think we see a move to 180 or 190 on Nvidia, and then we'll see how that plays out from there. How about this chart of Netflix? You've been looking for a place to go on the bullish side while the market's trying to figure out what it wants to do. Look at this fantastic 5-wave to the upside pattern here on Netflix. And we have a bit of a diagonal pattern set up here, almost a pennant. Move to the upside, 38% wave 4 correction, looks to a 61.8% wave 5 extension. We haven't quite gotten there yet, but we hit that wave 5 target, and that's exactly where we'll be. Why is Netflix moving to the upside? Well, if we are going to move into a recession, which is kind of really clearly indicated by the, we take a look at this here, the yield curve, and holy cow, the inversion just continues. I talked about this last night as well, talked about it in TradeFinder too. I can't remember, and I've been trading options for over 25 years, but in the time of coordinating with the bond market, I can't remember an inversion that's been this significant for this long. The bond market is screaming at us. The equity market's not paying attention, but that might be a mistake. We'll see, but you can see where the 2-year is on the rates and then where the 10-year is. A significant inversion there. So if we are going to go into a pretty significant recession, more than just a mild one, is everybody going to stay home and start subscribing to Netflix again? Pretty interesting pattern there on the move to the upside on Netflix. Bitcoin, wow. We thought it was going sideways when it was bouncing between 18 and 20,000. It's just going dead sideways now. The positive is it's staying above 16,000. If Bitcoin breaks below 16,000, I do think it goes to 12, but so far it's held above 16. It's weathering the incessant news that we get out of FTX every single day. It seems like there's some sort of commentary about FTX and the contagion effect with cryptos, etc. But you have to be encouraged with the fact that Bitcoin is not only holding above 16,000, it's kind of trading on a dead flat line at 17. The longer it does that, I think the better chance we have of another run up to 20,000. We'll see if that plays out, but 16,000 is the key to the downside. Taking a look at some of our international markets, looking at Australia, right up to that wave 4. Now this relabeled into a 5-wave to the downside pattern. And you can see why. We hit the 61.8% fib level on the wave 4. Are we heading down in the wave 5? We'll have to see. 23 is a key level on the EWA. As long as we hold above that, I would submit to you that there's an opportunity for the EWA, for the Aussie market, to break above that wave 4 and disqualify this 5-wave pattern. But until it does that, you have to respect it, especially with a 61.8% wave 4 corrective level. You look at the moving averages, trading basically all week, dead on the 10-day moving average. Canada dropped down a little bit. So once again, you see a wave 5 that extends more than 100%. So we're looking for a 61.8% correction, and look where we went. Exactly to the 61.8% level. You can't make this stuff up. This is why Elliott Wave is important. This is why Elliott Wave works. You really need to make this part of your trading regimen if you haven't already. You're coming to the right place to learn about Elliott Wave and fib levels. Right to that level. So what do you do now? You be patient. Let the market give you the next impulse move. Wait for the next Elliott Wave labeling on what happens with Canada. Looking at India, moving to the upside. The wave 4 finished less than 100%. You go back to the previous 4. We did that. So then you start looking at, all right, well, where do we go from support resistance? 44 was resistance. Boom, boom, boom. 4 times we've hit 44 and backed off. So does that mean we got to hold right here? I mean, if you're long the INDA, you need to see it hold right here, because look how vertical, not vertical, but this nice 45-degree angle move here, but there's no real support on the way down. If we break below where we are now on the INDA, we're probably coming down to test this level right around the 41 area. But so far, as long as it holds it, we have a chance to try again to break above 44. So right in here between 43 and 44, once again, be patient. Let the market tell you where we go from here. Hong Kong, you've seen the news about China relaxing their zero COVID policy, etc. Look at this zigzag. Talking about zigzags with our zigzag mastery course, you can see there's a nice zigzag pattern. You're supposed to go to the 61.8% level when you get in the area of 38.2. That's exactly where we are. Where do we go from here in Hong Kong? Perhaps we need to let it tell us as well, because we're overbought. So we hit the 61.8% level. We're a little bit overbought now, so perhaps a little rest here in the Hong Kong market and then see if we have enough energy to try to make a run up to that 100% extension. I would say that has possibility, but not now. You don't want it to try it now if you're long the Hong Kong market, because if it does, it won't hold. It'll fail because we're already overbought with the separation from the 10-day moving average. Let it catch up. Let's go sideways for a little while. Let the 10-day moving average catch up and then try to make a run at that 100% level. Thought I would throw in a couple other securities of interest. Here's the SLV. Look at that, a nice wave 3. We've been waiting so long for a bid to come in the metals, and here we go again. You see why we talk about these zigzags all the time? Look at that. So it's supposed to go to 61.8. That's where we are. Same exact scenario that we just got done talking about. Is it going to break and move to the upside? We put the 10-day moving average on. It's overbought just like Hong Kong is. Maybe not quite as much, but the same scenario. See if it can go sideways for a bit and then make a run up to the 100% extension. But at this point in time, it's a completed zigzag based on the B wave correction. Then you just look to see, are you going to get an extension? Well, one of the things that we like to look at Evo Trader is the DMI as a confirming indicator. When you have a C wave extension and you're looking to see if we're going to go to the next fib level, what does the DMI say? And that's about as strong as you could set up a DMI. It's showing there is strength to this move to the upside, and it's likely that we will go up and hit that 100% extension. Now the question becomes, when will it do it? I submit to you again, it would be more bullish for it to go sideways a little while and then try to make that run. And then last but not least, oil. Everybody's been talking about oil, OPEC, everything else on the case for oil going higher. I did submit to you several weeks ago the scenario of, well, demand matters too. It's supply and demand. If you cut the supply, but the demand falls off, you could still go to the downside. We've got a 50% wave 4 correction in this 5-wave impulse pattern to the downside on oil. We're only at an 83% extension. That could go down to 100%, meaning that we may not be done going lower in oil. So again, it doesn't matter how much you cut the supply if there's no demand, and that would be indicating a significant recession. Then, oil's still going to come to the downside, much to the chagrin of the OPEC ministers, etc. We look at the 10-day moving average. We are a bit oversold now on oil. So perhaps a little bit of a bounce up, test that 65 level would be warranted, but I'm not sure we've seen the low yet, at least not in the near term on the USO. Hope you found that informative. Have a wonderful weekend. Look forward to talking to you again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.